anybody has questions.
Now is the perfect time.
So I'd like the students on the other team to have the first crack at questions, please.
How do you guys go about your required rate of return?
We set it as a private investor, 25%.
So it's discretionary? Okay.
Anything else, guys?
How many comps did we use
Wait.
for that?
Oh,
Yeah.
You guys did it, if I heard correctly, you weighted the income approach at 0%,
Correct.
and that's solely because are they receiving revenue or are they just pre-profit?
4 million in revenue.
So they're positive with revenue, but they're not making any money yet.
Yeah, the
They're
free
not
cash flow is
pre-profit.
negative, and because of a negative free cash flow, it kind of breaks the DCF, or like, it just returns an implausible, unreasonable number.
With a 20% growth rate, in 5 years we would turn positive, and get a positive free cash flow.
Okay.
Alex, did you have a question?
Mine was to do with the 0% on the
Okay.
income approach as well.
I have a question.
Please, Dorothy.
So, you said the rate of return is 25%. Have you guys considered any adjustments around that? For example, taking into macro economic factors like GDP or like any industry analysis you have done? Or it's just set 25%?
It's not a whack, right? There's no beta, there's no like risk-free return. It's really just as investors, we were like, if we were to invest in that, we need a high return, and that high return, we decided on being 25%.
Which isn't outrageous for the industry analysis that we conducted.
Yeah, because it's also based on our comparables. Like our revenue growth rate is at 20% because that's where our comps come out at. And those comps are the private investor, not private companies that in the list that Oscar did. And so.
I might have missed this, but what did you say was the industry analysis WAC, like for the comparables? What did their WACs come out to be for the companies that you compared this to?
They didn't use
We didn't
the
use
average
You guys
cost
didn't use,
of
you guys
capital.
didn't use WAC at all? Okay.
Yeah, you guys have been schooled to think about WAC as the discount rate coming from the perspective of the firm, but I'm not sure how relevant that is to you in this. You're coming from the perspective of a would-be buyer, and so their discount rate is going to be their risk-adjusted expectation for returns, right? So WAC is not irrelevant in our construction here, but I'm not sure how relevant it is with these presentations and these valuations. It's just a discount rate. Got to remember whose discount rate it is. One more question, and then I'd like the two mentors to chime in, please.
For the income approach, did you think about considering adding in a best owner premium for maybe a firm such as Yelp? They have the capacity to grow this at an expansionary rate, whereas some investor that doesn't have that ability, they're not going to see that potential. So for a company that actually would think about buying a company such as No Wait, there might be some sort of best owner premium.
That was pretty heavily debated between us on whether we were going to look at this from Yelp's perspective, but we really didn't want to look at it solely from Yelp. Yelp had already bought the company, right? We wanted to look at this from an outside perspective and say, we're an outside investor, we're going to do a valuation that hasn't been done. So if anybody else wants to chime in on that too, feel free.
Yeah, another thing to keep in mind when we did the DCF for a private company though is that because we really don't have any data about the company except for the acquisition date, which is for No Wait, it's fiscal year 2016. How we did the forecast for the future years is we really looked at the comparables and how those are growing, and then what's the margin on the companies. And that's how we break down our cost structure. We also take into account adjusting the different costs between the differences between private and public company, which there are a lot of differences. So,
Yeah.
yeah.
And yeah, and I think like to answer your question specifically, that what Preston said, the reason why we didn't include the best owner's premium is because we had a different perspective, and that was also the reason why we took off the goodwill on the asset approach.
Preston, got a question?
Can you guys speak a little bit to what it's, from the way you guys are answering these questions, it almost sounds like you are valuing this company as if Yelp had not acquired them. Is
Exactly.
that correct?
Yeah, they would be before
So
the
this is not,
acquisition.
this is not a point in time today valuation of the company.
It's
day
not,
before the
we
acquisition.
didn't want it to be a recreation of the valuation that Yelp already did and the value that we already have. We didn't want to just justify the value, and like, you know, with the DCF, as everybody knows, you can tweak and twist to the, pretty much to come out at the whatever value you really want it to be. But we said, okay, let's kind of step away from that value. We saw 25 million goodwill, we're like, okay, that's a pretty hefty best owner's premium and other things included. Why don't we take a step out, take a different perspective, and kind of are neutral or have really kind of no idea where the value will fold, and kind of see where the different methods come out to and what was reasonable and what not. And so yes, it's not necessarily that Yelp didn't acquire it, but it's at the same point. Let's say Yelp had an offer and we offered to invest like a buy a minority stake in the company.
So the financial forecasts that you put together were looking at this company independently without any increased efficiencies as if it had been acquired by Yelp. This is the evaluation as of today. If Yelp didn't acquire them and they continued to operate.
Yeah, it's like by themselves, we buy a minority interest in Nowait, not in Yelp.
So is it a valuation as of today, or a valuation as of the same point in time
As
that
of the
Yelp
point
did
in
the
time
acquisition?
that Yelp, because
Okay,
the
right.
financial statements that we have is really kind of the day
Right.
and the year before the acquisition, and no other, so it would not make sense to take it off today, because like that's already a year back.
Understood, and you guys might not realize, but each of the two teams, you had the latitude as to what point in time and what perspective you were going to use. You didn't get any hard instruction on that, so I'm fine with this.
Yeah, my question was more if built into that valuation, they had considered any kind of Alex's question.
Yeah, it is Alex's, but yeah.
Exactly, yeah.
No, and I think the answer is the same, right? Like if we did that, if we had considered Yelp buying it, we would have to have considered a best owner's premium in certain
Definitely.
synergies, and because of that, we did not.
Absolutely, yeah.
So, Jeff, what questions do you have for your team?
Here's my fundamental question. You've got your DCF that shows negative $6.8 million. You've got a market approach that shows anywhere from 15.5 to $23 million. Why in the world would someone pay $23 million if I'm never going to get a return? Or why would someone pay the 15.5 we found with the Republic method, or the roughly 17 related?
I mean, so the idea is that it should be at least, I like the theoretical floor of a value should be the asset approach. It should be at least be worth its assets, hopefully so. And so that comes out at $13 million, it plus minus give me a few hundred thousands. So that's kind of a floor. So if I were to buy this company, all the effort that went into creating the app and such has certain has a recreation value for me if I had to like code that all myself. So it should be worth that, and then in a kind of that's kind of a floor. And then when Oscar went into the multiples, that's kind of a arm's length transaction. It's negotiated between a willing buyer and a willing seller, and therefore it comes out a little higher because of that. And that's was the indication of value to us.
Okay, so you've got two pieces there. You got your asset approach and market approach. Let's dig into both of those a little bit. On your asset approach, what I just heard you say is that sets a floor because I can go out and sell those assets. Someone would pay a recreation cost. Why would someone pay the recreation cost for an asset that will never generate any income? Or not in the foreseeable future?
We did see revenue of $100,000 into year 5. So there is revenue there, but that's conditional upon a few factors. So I'd agree with you that you're probably not going to see it immediately, but you will see profits.
Okay, but. I
Going
guess
back to the question again, like,
If I'm gonna
yes,
see profits, why is my DCF negative?
because the assumptions that were built into the DCF, Louise, what would you say were,
Okay, so we don't know. I think the answer,
Yeah.
we don't know,
I
we don't know
yeah,
why
I
we
really
don't
don't know why it would come out to
And-
negative $6 million.
So channel your best oswath, okay? If it's not gonna make you any money, then you gotta pay me to buy it, right? If it's not gonna make any money, you gotta pay me to buy it. So asset-based, comp-based, anything-based, you gotta be able to formulate a really good response to Jeff's kind of question. In fact, you're gonna have to formulate a response to any challenge as it comes to you from someone questioning, and you'll get those questions if we make it to Georgia, but even before that, you need to build into your presentations in the 12 and a half minutes you didn't use, you need to build the rationale that heads those questions off at the pass, so that they're not asked. Okay? What else, Joe?
So, on the market approach, it's really, fundamentally, my fundamental question with your evaluation is the huge disparity in that, okay? So we talk about the asset approach. Market approach, I really got the same question, so I don't need you to answer it because you've already kind of given me the answer, but the question I would be asking is, okay, you got $23 million, how are we gonna generate money? I guess I'll, my food for thought for you guys and for the class. My rule of thumb is that the 3 approaches should be about within 10%. And if they're outside of 10%, you've probably got a mistake in there somewhere. And so there's your DCF, the assumptions you made in the DCF are obviously problematic. But the market approach is just a shortcut for a DCF.
And the solution to your DCF problem is found within your market multiples. We'll come back to that. Robin, what comments or questions do you have for these? Be ruthless, honestly.
Yeah,
They got shoulders.
I have a comment. I think the company is not focused on profitability. They're focused on user growth. They wanted to get acquired by Yelp or someone like Yelp. So they invested heavily in the technology and invested heavily in users to kind of grow that user base. And the value was all in goodwill and intangible assets. So there is a huge disparity in value. It is problematic, but anyone with negative profit, it's never really good to do a DCF because you have to fudge the assumptions, and it's to get it where it needs to be, and you're just going to get drilled on those assumptions. How did you guys select comps when you thought about selecting your public comparables? Like, what was the thought process? What made you, and did you do it at the same point in time where the valuation was?
5 years from 2016, or 4 years. Same size, about same size. It was.
We can pull that slide back up.
Yeah, we could. The revenues was 4 million. I went from revenues between 2 and 14 or something. And for assets, it was 8 million assets. I went between 4 and 20 million. Employees in the company, we couldn't really find a complete number, but it was somewhere between 10 and 50, 10 and 60.
So is this the private company criteria, or is this the public company criteria?
Looks like they got both. Public.
Yeah, I looked
Got it.
at the same criteria for both.
I think there were 14 or 15 for each.
These are from PitchBook, these are public ones, and these are private.
What else, Robin?
what was the cash position of the company?
1 million in cash on hand.
I think so, yeah.
I think it was 6 million.
Or was it?
When you
I'll
go
pull
back
it.
to
It was
the
6
asset-
million, and
12 fiscal year
in the
2016.
asset approach, it was 1
16.
million left after we took out the.
Ah, okay,
Yes.
okay. That's what it is.
That's 60 million.
So, can I ask a question to the mentors?
Please.
If we're the same thing, like an outside investor, going on Robin's comment that the idea is to get acquired by someone who's really just growing it, like people that user base,
Mm.
would we, if we, as an investor, would I consider like certain amount of the goodwill, or would I take the whole goodwill out that I see now? Would I say, oh, well, an acquirer is likely to pay like that premium or certain synergies? Would I consider that when I invest in it, or would I say, well, that hasn't happened yet, that's a goal, and I would not do that?
You're operating here with information that a person who's really in the situation you described wouldn't have, okay? Because you've got this purchase price allocation that's an accounting function. Does everyone understand what a purchase price allocation is?
Yes.
I'm not sure that they all do.
Okay, so what happens is when Yelp comes in and buys No Wait, for accounting purposes, they're required to come in and do a purchase price allocation. Basically what that means is they're gonna take the purchase price that Yelp pays. This is to put all of the assets on Yelp's books. And so what they're gonna do is they're gonna go through and figure out what assets did we acquire. And some of them, you know, if they're receivables or something like that, that's pretty easy to value. But then they're gonna have to value customer relationships. What's the value of the customer relationship? What's the value of the trade name? What's the value of any non-compete agreements that we acquired? And you basically say, okay, first step is to calculate the purchase price. The second step is to calculate all the values of the assets that were acquired. And then the third step is to plug the difference, and that difference goes to goodwill. And so here, we've got almost $26 million in goodwill, plus we've got, you can see they've got customer relationships of $9 million, they've got developed technology of $2.9 million, and they've got trade names of $610,000. If I'm coming in and buying this without Yelp having been involved, I would not have access to that information. And that's something, you know, you would never actually see an asset approach being done for a tech company. Because you have to do it like this after the acquisition. So this is all done post-acquisition, so that the auditors can come in and look at it and sign off on it, and then it gets reported to investors. But pre-acquisition, you're never going to have that data. So you really conventionally would not use an asset approach for, you know, particularly an early-stage tech company. You know, asset approaches are going to be used for a much, you know, an asset-intensive company, you know, a tangible asset-intensive company. So coming back to your question about the goodwill, the way that gets created from an accounting standpoint is only in this acquisition. The way it gets created from a more, you know, economic, forgetting the accounting aspect of it, the way it gets created is through the operations of the business, through everything that's, you know, the synergistic component of bringing all of these assets together with one purpose. And you would, I mean, as an investor, you would be willing to pay for that. The question here is how much of that is what Yelp's bringing to the business versus the existing goodwill that was in the business, and that we can't answer.
What you could have done perhaps, and maybe I'm seeing it here and just I'm confusing my apple and orange, is consider the assets that No Wait had on its balance sheet preparatory to the Yelp acquisition, not reflective of it, okay? So the assets that I'm seeing on the left-hand side in your table, are those from the balance sheet
That's
prior?
just-
Those are there's that one line item
It's
that you.
this one.
Okay, all right.
This one.
So
Yeah,
again,
it's
that's after, that's
post-acquisition.
purchase price
Yeah.
allocation.
That's posted, yeah.
As
Because,
post-acquisition.
and you can use assets that are not reflective of the acquisition, but then you need to be able to say why those assets have those values. So one of the things I was sitting here making notes on is, okay, what are these assets that you think have this great valuation? Because I wouldn't see in a company like this assets that had any meaningful value to them at all. I mean, this whole developed technology issue, what's that? They probably expensed rather than capitalized their R&D, right? Certainly. In which case they aren't carrying it on a balance sheet at all. So what is this? I mean, is it intellectual capital, human capital, would-be capital, maybe someday capital? It probably isn't currently capital, right? So to just comment, thinking about a tech business from an asset standpoint is pretty dicey. Moreover, and I think you're going to find this from the adjudicators when we actually start to submit and present. Moreover, it's irrelevant to the vast majority of us what the assets are. It's relevant to us what we're going to get from those assets. Here's one thing I know. If you've got $10 million of assets on a balance sheet and I have to liquidate you out, I'm going to hope to clear 5, and that's with a prayer, right? I'm not going to get 10 by any stretch of the imagination. So you'd have to discount that terribly, and then we better have a reason to think there's going to be some meaningful revenue coming off of this. I think part of what Jeff's saying, and I think it's inherent in what Robin might be communicating here as well, is that, yeah, the DCF doesn't work out because you got some assumptions in there that clearly are not the assumptions the market would use. How do you identify the assumptions the market would use with respect to growth on this assets cash flow? What information do you have that tells you how the market is assessing this? And not the Yelp transaction. Think about your multiples and think back to the algebraic disaggregation of those multiples. And one of the most important and finicky components of that algebraic disaggregation is G. If you know the multiple and you know the cash flows and you know some return on invested capital, you know some expected returns, your R, you can reverse engineer G, and I guarantee you it's more than 3.9%. It has to be massively more. Otherwise, there would not be, Yelp never would have written a check. And nor would you. And I got to tell you, you present this to me, and I thank you for your time. And that's because I'm polite on the first go-around. They know me well enough to know not the second go-around. Okay? So think about that, all right?
I've got a question for you as well as the mentors. So if you were valuing a company that was very asset based and it was a well-established company and you could do an asset approach analysis, would it be more to your value to look at which of those assets are liquid, which aren't? So like let's say there's a building that's worth 10 million, that's not going to sell right away, so maybe weighting that base or giving some sort of discount to it's going to take some time to sell this. Is that something that you take into consideration?
So when you're looking at an asset approach, you can look at that from the standpoint of, okay, a fire sale liquidation, it really becomes almost a liquidation value,
Mhm.
okay?
Yeah.
And you can look at it from a fire sale liquidation standpoint that my building's not a liquid asset, but there's a price at which it becomes very liquid.
Sure.
It's just a huge discount. And so you can look at that, or you can say, you know what, I'm going to dribble this out over time, and my building's going to take me 6 months to sell, and maybe I'm going to keep operating certain aspects of the business while I do that, and really maximize that value in order to get cash.
Got it.
Yeah, so it may be less about their technical liquidity, the way we think about current assets, long-term, et cetera, and more about their saleability to get reasonable price, right?
Which, just coming back to these guys, you guys mentioned that the asset approach really sets a floor. Totally agree with that. The problem is, the vast majority of the assets you got here, I mean, at least 13 million of them, you can't go sell those. You know, No Wait can't go sell its customer relationships on their own. It can't. There's no market for that. There's no market for developed technology on its own. And so really, the asset value on this is maybe $2 million less its liabilities, which would put it at $1.2 million for equity value. That's, you know, again, I wouldn't use that to value this company because there's clear value to that technology, but not in the traditional asset approach sense.
So coming back to your market approach, and you probably said it and I missed it because I was making notes and watching time. What multiple form did you consider Was it a sales, EV, EBIT sales? What were you looking at?
Enterprise value to sales.
So EV to sales, okay? And so when you look at that, not only think about that algebraic composition, the disaggregation, but think about what is your story that you're telling us to cause us to believe your sales are going to grow enough for this to be really valuable. You gave me gave us a 3 and a 3.9% story, right?
I think that was the long-term growth, right?
Yeah, that was the long-term growth rate.
So-
The short-term growth rate was 20%.
Wait a second.
Okay.
Wasn't that your sales growth forecast? The 3.9? You were talking about
Long-term growth.
That was long.
Yeah.
Well, I thought I saw something up there that said there was a 3.9% expected
There was,
industry average growth rate. So that being the case, where are you getting 20% from? The industry's doing 3.9, where's your 20 coming from?
So you can go back to it and I can walk you through it, Rick, if you want to.
And you don't need to do that, I want you guys to think about this. Okay?
Well-
Because I'm not writing a check and neither are you, right? But what I want you to think about is you had 11 and a half minutes in which you could have woven a great story. Okay? Now, don't get me wrong, you guys did a great job, okay? First shot on this, first one of the two teams, okay, you guys did a great job. Just think about the resources at your disposal, because all we're really doing is talking about the resources that you could be thinking about that would help bolster this, make it stronger, more credible, so when you come back at another one of these in a couple of weeks, and then at the real McCoy here soon after that, we've got something that is rock solid and bulletproof. Let me give you a couple other things real quick. Obviously, we got a little bit of timing of who's speaking, who's commenting, what slide is going on. I tried to locate my clicker that advances our slides, but unfortunately I loaned it to somebody. So I'm going to buy another one. I'm trying to put a face and a name to the person I loaned it to, and I got neither coming out of my little head. But what I know is it's no longer present. In your voice, you know how I talk loud, right? In fact, I talk kind of dramatically loud. Why is that?
Everybody can hear it.
So you can hear me. So there's no ifs, ands, or buts about it. And some of you, I can barely hear. Kuchata, I love you. And for years, right? Honey, you got to speak up. You got something going on there. You got a voice. You got something to say. Make us quake in our boots at your power and dynamism. All right?
Can I just add something?
Please.
Fake it till you make it.
Yep.
I mean, when you talk a little bit louder and confidently, we believe that you believe your number.
Yep.
So project that you believe your number, even if you don't.
I've told you guys things over the years that you're absolutely certain was right, and I'm still not sure it's right. But you're sure it's right. And I'm hoping this isn't true, by the way, but it is the point we're making, okay? Posture, who you're addressing, where you're looking to. I can get away sometimes, you've seen me do it 1,000 times, of speaking while I'm looking at the board when I'm talking in front of a classroom. You can't do that when we video, okay, so think about that. Especially, you can't do it unless your voice is crisp, sharp, and dynamic. The only reason I get away with it is because I'm a loudmouth to begin with, okay? And then I amplify it as I bounce it off of a hard whiteboard. Okay. There was one other thing. No, I guess that's it for this one. What did Yelp pay for this? You said it and I missed it.
40 million.
And they invested like 6 million 2 years ago. The private-
Yeah, another
Prior
6
to
million?
acquisition.
Yeah.
Yep, I'll be waiting to see when it comes back on the block for 5 million.
So I have a question. Like, when you're talking about the story, like the cash flows, not the sales, but like the free cash flows, they're pretty negative. Like, we already had to put a pretty aggressive growth rate, which you already kind of criticized, and like rightly so, at 20%. Where do you come up with that to just even get like?
Well, no,
just
I didn't
barely-
criticize it. Honestly, Mike, I think it's understated. I think that for this thing to have legs, A 20% growth rate is understated. By the way, I think the 25% discount rate is also understated. I think this represents a risk that would warrant a discount rate that's yet greater than that. If I'm in a VC or a private equity world, I am not touching this for 25%.
So you check both up?
Pardon?
You put both up?
I take both of them up.
But mathematically, your growth rate has to go up more than
More
the
than
discount.
the-
Yep,
Yeah.
yep.
But like, how would you, like,
What are we
I
getting
mean,
at?
I just think, like, you would just get, you know, how would you possibly justify, like, let's say 4 times the industry's growth rate?
So there are a few things going on there. One, industry growth rate is talking the entire industry. It's very hard to grow the entire, I mean, just think of magnitude of dollars.
Yep.
You know, doubling $1 is a lot easier to do than doubling $1 million, okay? And so these guys are much smaller than the industry as a whole, so it's easier to grow that. That's the first thing. Second thing is what Rick was talking about with the multiples. The multiples are applying massive growth.
Right.
And that's a great way to support it. The market is telling us that they're expecting this type of growth out of these types of companies. You guys didn't have this, but hopefully in a real valuation, you have multiple years of growth where you can see, I mean, I got clients that are growing north of 100%. You know, and you can see them. I had a client that went from 200 million to $1 billion in sales in like 3 years. That growth happens. You can find that out there. And if you had the benefit of looking at their historical growth, my guess is these guys are growing close to 100%.
Because they're not at scale yet, or even anywhere close to it. Now, once you're at scale, every ounce of growth, every inch of ground is hard fought, right? But coming up to scale, it's not nearly that challenging. Not nearly. So I'm not assailing that it's too high. If anything, I'd be assailing it's too low. And the multiple, I think, is your key to what that growth rate is from the perspective of the market. And I'm happy to help you guys work through that. Okay, so we need to get on to the next one. Honestly, good job, you guys.